All right. I got so many questions. So thank you for sending them. I did this a little different than our normal Q&A sessions if you've attended them before. I tried to include a slide answer for every question. So it's pulled from various presentations. So there's going to be a lot of information and I grouped it together so it makes sense to make sure there's a congruent order. So thank you for all the questions that you sent. There is some beginner, there's some super advanced, there's some market mechanics, and there's technical analysis and market views as well. So there's actually quite a bit of information within this today. So I'll see if we can get through all of them. I think there might be 50 slides altogether. So thank you for sending all of that information. Nonetheless, let's go ahead and dive in. And before we do, I don't have the disclosure slide inclusive of this, so I'll just go ahead and give them to you. No, it's for informational, educational purposes only, not intended to be legal, financial planning, or tax advice. Financial advice is personal. I don't know your personal situation. We're a broad-based audience, so therefore take that into account. This is not intended to be that way. You can talk to financial advisors, normally complimentary at your brokerage firm. So definitely be cognizant of that and keep that in mind. And all right, hello from everywhere. I love that we always have people from so many different locations. So great to see you all. So let's go ahead and dive in today. Like I said, I did have the disclaimer. Look at that. A lot of questions. So first and foremost, I do have my laptop, which means I can only have the chat or the Q&A. So I'm just going to keep the chat window open and I'm going to exit out of the Q&A. So if you're putting in anything on Q&A, I'm not going to see it and then I'll minimize it throughout because this is the Q&A session. So the way that I've grouped this together is really in a congruent order. So starting with strategy selection, strategy management, there's a couple of market mechanics. So we'll talk about that, then market views, and then some one-off, even margin questions I threw in there. So stock splits and things like that. So I tried to cover everything that I saw. So thank you for sending in those questions. And also before we dive into these questions, if you have a very specific topic that you want for next week, I haven't sent that out and I'll be sending out making sure that our lovely team sends out the topic that we'll be covering next Thursday. So if there's something very specific that we haven't covered in a while or you want to hear more on, please let me know. In that one, please put into the Q&A because then I'll be able to see it without having to go back through the chat. And I'll make sure we cover that this week. So just want to make sure that your voice is heard. Nonetheless, let's dive in. First, we have when to pick a debit spread versus a credit spread. So starting with the strategy specific. So I wanted to start with showing you this chart. You might have seen it before. This is what I like to call our most stolen slide here at OptionsPlay, but it gives you an indication of the individual option strategies. And this is something we start in the beginner concepts, and then we build it out all the way to the Greeks. So this is the build out version inclusive of the Greeks. But what's important about this, if I'm trying to understand, if I'm going to do a debit spread versus a credit spread, I need to understand my goal of that strategy. Now, the reason why I'm showing you each individual leg, a debit spread is either going to be based off of a long call or a long put. The debit spread is an extension of those strategies, whereas a credit spread is an extension of a short put or a short call. So we can still utilize this T-chart in order to understand which one do I want to deploy. And it's such a wonderful question. So first and foremost, it starts with an investment thesis. Am I bullish versus bearish? And what you'll notice from this T-chart, bullish strategies are on the top and bearish strategies are at the bottom. If I am bullish, perhaps I want to choose, do I want a bull call spread or a debit spread, so an extension of a long call, or am I looking at a bull put spread, which is a credit put spread, so debit versus credit, back to that original question. The one thing that I would need to look at first and foremost is we've defined my sentiment. Which strategy am I going to deploy? What does implied volatility look like? If implied volatility is heightened, it would benefit me to be on the sell side. However, we're adding a long leg in either one. A short put is going to have a further out of the money long option, and same with the long call. So we need to understand how to kind of layer theta appropriately, if that makes sense. Because if implied volatility is heightened, that's going to benefit me from the short side, but that could also be a way to structure my long call where I could utilize where implied volatility is heightened to reduce the over cost of the long call. So hopefully that makes sense with number one, implied volatility. How can I use that to my advantage? Does it make sense to sell or buy? Second is really directional bias. You'll notice that long options profit from a sharp directional movement that's inclusive of the debit spread. We're mitigating that when we're capping our upward potential. But this is how I would decipher from them. If I was expecting a large move, and I really think that's going to overcome the theta, I would purchase a debit spread in that case, a bull call spread if it was to the upside, a bear put spread if it was to the downside. So extension of the long put. If I expected the underlying security just to remain exactly where it is or move ever so slightly, then a short put, because that's a neutral with a slight directional bias. So it really comes down to two factors: implied volatility. Is it expensive or not? If it is, either way, you could use either one because they both have short options, they both have long options. But the difference is my directional bias. Is it a larger movement, or is it just where the security is going to stay exactly where it is? And then there's another question that goes through strategy selection that we will focus on. But that is the answer to your question. How do I choose between really long versus short, debit spread versus credit spread? It's really that simple. Goal. Do you expect it to stay where it is, or do you want to move a lot? All right, don't want to spend too much time there. What is the best way to protect my portfolio? I was thinking of buying SPY puts. I love this question. I actually combined it with the next one, I believe. Yes, in a high-risk trading account, how much downside protection should I have? Should that be tiered by expiration date? So this is one of my favorite presentations that I pulled from when we talked about beta weighting and assessing your risk associated with that and correlation. What is beta? You have probably heard of beta before. If not, you don't need to know the math, even though I put it there. But it's the measure of volatility or systematic risk of your portfolio or the overall market. For example, S&P 500 has a beta of 1. That's the benchmark. And QQQ or even Tesla or Nvidia are going to have a much higher beta because they're more volatile. They have a more aggressive roller coaster up and down. So in order to understand how I'm going to hedge, you need to know what index really relates to your portfolio. What is your beta, and what portion of that do you want to hedge? Because you can do a whole math calculation in order to understand that hedging, but it starts with the correlation, and you can hedge a portion of it. You could hedge an individual security. You can hedge an individual sector. There's lots of tools on your brokerage firm where you can see your sector allocation. There's portfolio x-rays. It's on a vast majority of them. And so if you perhaps are thinking technology is overbought and risk to the downside, you could hedge a portion of that. Or if you want to do your whole portfolio, you have to find an indice that highly correlates to your portfolio. You can utilize an index option or an ETF, and I've got some examples on the next one. But utilizing beta. So this is SPY beta, which is the market beta. That's where that number is, the benchmark is derived from. This figures, like I said, this was from an older presentation, are a couple months old. This changes as math does. So QQQ, for example, a beta of 1.24, that means it's 24% more volatile, which absolutely makes sense. If it's full of growth securities, technology securities, they tend to move quite a bit, even though the market, arguably, as measured by the S&P 500, is now so much technology. And as we said at the top here, how it's being driven by NVIDIA. But if you look at Tesla, for example, 1.64, 64% more volatile than the market. And that just means when it goes up, it goes up. And when it goes down, it goes down. We've got inverse correlation, like the SH, which is an inverse ETF that tracks the S&P 500. If you have leveraged, so SPUU is a ETF that is 2 times the S&P 500. So it's going to try to be, but those are intended to be used daily. So this does not work for longer timeframes when you get to the leveraged or inverse products. That's important to know. And then PG, Procter & Gamble, low beta stock, cyclical stock. It's 53% less volatile, has a lower correlation to the market. But essentially, when you're trying to define how do I hedge my portfolio and what indice do I utilize or what ETF, it depends on the correlation of your portfolio to decipher that. You could use the S&P 500, but that would not truly hedge your portfolio if you're not a market weight all around. And it's going to vary based on really the deltas of your entire portfolio. And this is an hour-long presentation on how to do that in particular. If this is what we want next week, we can certainly do that. It's one I probably wouldn't do with June being the month that it is, but if it's something you guys want, I'm here for you. So no worries. But to answer that question, it's finding the correlation. And then in order to hedge, you could utilize a collar. You could simply buy a put. You can do that famous hedge fund strategy where there is really 5% gaps. So it's a JP Morgan fund, and you can actually see it on the SPX options chain. I think it's very interesting to look at. And notice they can act a little differently because it's a hedge fund, but highly correlated to the S&P 500. They would choose something 5% up, so allowing a 5% upside potential from the S&P 500, basically create a covered call there, so sell a call, and then protection would be 5% to the downside. So that's a caller buying a put 5% down and then paid for with another short put. So it's a debit put spread and a covered call, and that's a way to pay for it all together, but allows upside with downside protection to a limit. And then as far as expiration date, it's like an insurance policy. It's not something you want to do often. You don't buy homeowners insurance to make money. It's something that can compound and really create the runoff rate. So it's not something you want to do all the time because it's going to make it very difficult to you have capital expenses when you are creating these type of structures if you're just buying a put constantly. So that's something to be cognizant of. Have a whole presentation on that, but that's the way that you would structure that on a high level and to give you some visuals. And that's probably the most detailed advance that we'll get for the most part in today's Q&A. So I just want to make sure there's anything crazy in here. Okay, and we'll talk about managing positions in a moment, so I'll leave those. All right. That's a great presentation, by the way. Give a detailed illustration of how to set up a credit spread. So remember at the top when I showed you the T-chart, a credit spread is a extension of a short put or a short call. A short put has substantial capital requirements, as in the total exercisable value. You're obligated to buy the stock, so it's the entire obligation amount. If it's cash secured, if it's in a margin account, it's roughly about 25% of the executable value. The short call has unlimited risk potential. If it's naked, roughly about 25% of the executable value, meaning that's capital intensive. The reason why you would deploy a credit spread is to mitigate your risk. So if I'm selling a short call individually is bearish. So the way, as in we don't want the stock to go any higher than that position, but to move slightly lower. If we expect it to have a sharp move, you've been better off buying a put. The reason why we buy a further out of the money call is to mitigate risk in case it moves adversely, because a short call has unlimited risk potential. So that's the foundational elements you need to know. Of course, I have some visuals for you. Here is, I'd rather start with the bear call spread, bear put spread. So the bear put spread, the strategy driver here, we would be selling to open the XYZ 100 put. This is profitable on the upside. So as long as the security stays above 100, then it's profitable. If it moves down, we have an obligation to buy 100 shares of XYZ at 100. So if it moves too far, then we would buy a put to give us, since we have an obligation to buy, we create the right to sell, see how they offset position. And then we are reducing our overall net credit by the premium received to 350, but we have a considerably less margin requirement. The margin requirement for this would be $10 less 350, so $650 altogether, $650 versus the full exercisable amount if this was cash secured, or 25% of the executable value. So that's why you would do this, is because of the capital intensive to mitigate risk. But here's a step-by-step how to create it, or what it is selling to open at your, normally at OptionsPlay, we would do a 0.5 delta, which is an at the money option, which is a little more aggressive. So that is a clear area of support or you think the stock isn't going to go any higher or maintain exactly where it is. If you want to be a little less aggressive, then you could do a smaller delta, which is just a further out of the money option. Remember, a delta of 1 is very deep in the money, acts like the stock. Delta of 0 is a neutral strategy. These together are the Greek, something we throw in the Greek strategy. And the bear call spread, same mechanics, inverse direction. And I apologize if I went through that really quickly, but we've got a lot of questions. So hopefully that one made sense. The question was, how do you show me an illustration of how to set up a credit spread? You set up the credit spread by first choosing the leg that you want to sell. That's the strategy driver. So in this case, for the bull put spread, and then I would choose a further out of the money option to offset my risk. And a little trick I learned a long time ago when actually I was working on an active trader desk, especially if you have four-legged strategies or things like that. The strategy driver is always the most expensive option. So here, the 100 put, that's a more valuable option. A put contains the right to sell. The right to sell at 100 is more valuable than 90. It's also more expensive, and it should be, because the right to sell at a higher price should be more expensive. That's a little trick to keep that in your mind, if you will. All right. This one, getting into the poor man's covered call, really. So I'm an OptionsPlay member and beginning to trade the wheel strategy. Your criteria to use for executing the best wheel strategy and the assessment of risks. I have a small account, around 180K, not enough capital to buy stocks, trading over $100 per share, and have a diversified options trading account to wheel. For example, using leaps or owning shares for the covered call side. Ideal days to expiration and delta to use. Thank you. All right. So I've got, again, this is from another strategy session where we've got a covered call versus a poor man's covered call. So this was a session we did on how to deploy a poor man's covered call. And a poor man's covered call is utilizing the leverage that exists with long options. Long options require considerably less capital than buying the stock outright. So if we know delta of 1 means the stock moves dollar for dollar with the underlying security, when we're buying options, we tend to buy time too, but time is removed if you go super deep in the money for the most part. So the intent is a 0.75 at the higher end, even a 0.9, that higher delta, a further out of the money, or excuse me, very deep in the money, further expiration option. So a leap is a long dated expiration option. So 9 months or greater is a leap. So very far expiration, very deep in the money. And if you've attended the Greek session, you would know if an option goes very deep in the money and has a delta close to 1, regardless if it's 9 months till expiration, if it has a higher delta, that means theta is still gone. And that's how it can act as a stock replacement strategy. So the intent of this is it's almost like a calendar spread, but it's the same mechanics and it would have the same profit and loss diagram as a covered call. The difference is a little more management and the capital that's required. So in this example, real prices, older time frame for GIS when it was around $70 a share, purchasing the shares would have a delta. So this is a delta of 1 here, selling a call with a 0.2 delta. And this is about a 30 days till expiration. So now we've got a further out of the money option or further expiration, very deep in the money option, 62.5, 0.75 delta. That's going to cost $980. So the difference is $980 versus the $7,000. Same call, allowing for that upside potential. They have the same mechanics, a little less of a gain potential that's there, but considerably less risk. So you're looking at risk versus reward. There is some give and take with this, though. If you are utilizing this type of strategy, and this is one component of the wheel is also means you sell a cash secured put in order to buy the stock. So it wouldn't necessarily work on the long call side, as in on the short put side. There's no replacement there, and I mean, there technically is, but it turns into a different strategy. It's from management perspective. The long call, we want that to be deeper in the money, so it replaces this option. But a long call still has an expiration date associated with it. Whereas the stock, we can theoretically hold it forever. The long call will cease to exist at some point, which means the poor man's covered call does require more management if it may begin to move deeper in the money. And and it probably will with this type of structure, may not, but it probably will. And if it does, that means it could be difficult to unwind because those deep in the money options tend to be very illiquid. So it's prudent to understand options pricing, utilize limit orders. But the intent of this is to deploy the strategy in a very similar fashion. Look for 9 months or later. That's going to constitute a leap. 0.75 delta on the high end, 0.95 delta or 0.75 delta on the lower end, 0.95 delta on the higher end. It's going to give you a deeper in the money option. And then at OptionsPlay, the same principles apply that you would utilize for a covered call, which is a 0.15 or a 0.2 delta. Why is that? Because it allows for capital appreciation. We optimize yield in addition to capital appreciation, because when you have a covered call strategy or a poor man's covered call, you're flipping the deltas because the strategy driver is the long stock in the covered call scenario and the long call in the poor man's call scenario, because it's the more expensive one. See how we tied that together with the previous. So hopefully that answers, the question of how do I do one versus the other? And the reason why this person asked it is because the capital requirements are considerably less. Right. How do you choose a strike price on cash secured puts, delta, below support, or other? So I brought in a real scenario for this because I was on Yahoo Finance earlier this week, and this was one of the charts I submitted. This one was as of yesterday's close, so I apologize, but the same concepts apply. This is a trade that I laid out, and I'm going to give you the thought process behind it. So Apple is a really good example. Apple has this major catalyst coming up, which is WWDC kicking off tomorrow. Therefore, that is a catalyst that could potentially put this stock above its trading range. But it has an issue, right? Like we've got a trading range is defined as it has a clear area of resistance, a clear area of supply. This is from 194 to 199. It's gone into that resistance zone. So if you are bullish on Apple in the long run, so I started with that T chart. Remember, a short put is an obligation to buy, but you are neutral short term, bullish long term. So I would, because I personally felt that Apple is going to implement AI at some point. It's rumored that they're going to release it in WWDC. Unsure if that is going to occur, or even more unsure of how the market will react to that. But Apple has a cash neutral strategy. They've got free cash flow. I've done my due diligence in order to put this together. So do your due diligence. And this is just an example because this was a trade that was laid out again earlier this week. Selling a cash secured put at this level means that this would be profitable as long as the underlying remains above my chosen strike price. So I would choose something around 195 or even 196. So that's an at the money option because I would want to own Apple. And the premium that I would receive at the time was around 250 for 45 days until expiration, or even at this case, I believe it was 23 days until expiration. And the only reason why I choose a less expiration date is because implied volatility was heightened for the 23 days versus the 45 days that we normally would choose because of an event. Event activity made it more expensive, which means I could get more premium for something shorter dated than longer dated. Those are just ways of analyzing ample opportunities, if you will, when you're going through that, then options chain or trying to find your ideas. So selling the cash secured put at this level, I was okay with. Because if they didn't release something AI, or they didn't do something where the market did not like what was happening and there was a pullback at Apple, that would have been around, right? The premium I was receiving got me right to another support level that I identified. And I would be happy owning Apple at that price. So that's the way that I would do it. It depends on different scenarios, though. If you're selling a put with the intent to buy the security, It begins with your investment thesis. Why did I want to buy this stock in the first place? You notice when I stated that, I talked about the events that were happening around Apple and some fundamentals and some technical views even that make me okay with buying this security, and then layered on the options approach as a means to buy the stock. So it begins there, and then that helps define, do I want to do this at an area of resistance or support? So I may not want to do this at an area of resistance unless I was expecting a catalyst of some sort, or there was heightened implied volatility. Whereas I might have been better off buying a call, but I didn't want to buy a call because if the market reacted adversely, I would be on a maximum loss and I would be trading a binary event. So that's the thought process behind that one and choosing that. Frank says that I'm going in and out. Can everyone hear me okay? Can you give me some thumbs up? If the connection is okay? Awesome. Okay, just want to double check that. Great. All right. What to do, and there's more technical analysis. Don't worry, we have the whole market in here. What to do if selling a put goes against you, i.e. the stock price of the underlying starts to go deep in the money. So when you're selling a put, you are bullish so we're going to bring back this Apple scenario. If I sold that put around 195, remember, a put contains the right to sell. So it's going to go deep in the money if it moves adversely, which is down. So my maximum profit potential of a put is keeping that premium that I received. And the reason why it's neutral to a slight directional bias is because that $250, that $2.50 premium that I would receive, we don't want it to rally more than that. If it rallied more than that, we would have been better off just buying the stock or buying a call, depending on other scenarios. So if it moves adversely, it means it's going to go down. Well, in this scenario, so it's going to go back to, why did you deploy that strategy in the first place? And this one, it's because I wanted to own Apple in the long run. So if it were to go to my support area, which would be this 13 weekly moving average around 182 or even this level, as long as it found its support, I would say my investment thesis holds true. I would be okay owning the stock and getting assigned. If you didn't want that, then I would close out of the strategy and mitigate my losses, reassess your investment thesis. But my thought process for that trade specifically was with the intent to buy the security. Now, if it moves adversely and I still had the intent to buy the security, but it's moving and breaking my support areas like it did here. Here, it gapped down. It did find support, so I would have been okay with it there because it was still on my support level. It maintained support at the 40 weekly moving average. But as soon as this starts flipping, that's a sign I would get rid of it here. That would have been my downturn because it failed to make a higher high, started turning over, the averages turned over. That is a bearish signal to me and my technical analysis process. So I would have exited at that point. So the intent of showing you that example is it's not as black and white, but it's also not necessarily gray. It's just process. If I was selling that put with the intent to buy the stock, why? When does that investment thesis change? And having a disciplined approach just behooves you in the long run. Now, Apple is, like Kramer says, don't trade it, just own it type of security. And I certainly agree with that. Good covered call contender. Wheel strategy is very good with stocks that are stuck in a trading range because you sell the put down here, call on the upside. And if it breaks through, fine. You just keep going while it's stuck in the trading range. And that's absolutely okay and creates income from a stock that's going nowhere. And that's where it can be profitable. However, your rules have to remain. And I've got pretty hard and fast rules from a technical view if you follow mine. But nonetheless, here you go. And Tamara's asking about we're going to get to those moving averages as to why. No worries. And this is all weekly views that I'm showing. This is a 3-year chart with weekly intervals. That's what the candles represent. And I'll go through why when we go through that. Can you tell me why and when I buy a call and it goes in my direction, so in my favor, my profit decline? It doesn't make any sense. Exclamation mark. All right, so I took a screenshot of OptionsPlay. This was taken 5 minutes ago, so as up to date as I possibly could. Again, on Apple, I don't know why I keep using Apple as an example, but it's the first one that comes to mind normally. What I've laid out here is I have got an August 16th around at the money call, so 195 call, and then a July 5th, a shorter dated expiration, 195 call. And what I've done, which you have to remember with an option, is an option, it is a derivative and is a derivative of an underlying security, in this case, Apple. But because it has an expiration date, it has these external factors that affect the option's premium. Those external factors are time value. So as the option nears expiration, it loses its time value component. You can see that as theta on an options chain. That's the daily amount that the options premium will lose, all else equal. Then implied volatility also has a factor. If implied volatility increases, that could increase the options premium. But if there is an event like WWDC or earnings or an anticipated market movement that's inflating implied volatility, as soon as that event has occurred, it deflates implied volatility. And that could hurt your options price. So you have these factors that internal, which is the stock's price, external, which is time and implied volatility, that adjusts the options premium, which means if the stock price moves, but time has gone too far or implied volatility has collapsed and the stock didn't move enough, then yeah, your option will go down in value. Like here, this option is at break even because we paid $5 for it. It's July 5th. So this was saying trade deployed today. Now we go to July 5th and then the Apple went up by $5 to 200. Because of all the decay, we're at break even because it's only worth 5. So this it lost its external factors, but it gained internal factors. Here, it gained a little bit because it still has some time value associated with this. If this wasn't a screenshot and I moved this further, these both would end up being in the red. So that's what's important to know here. Well, this one won't. This one will stay at break even because it's at all intrinsic value. But this would start getting in the red because it didn't move $8.35. And that's why that T-chart in the beginning and why we say long options expect a sharp directional move because you needed to overcome the trade cost. And that's why both of these had a poor options play score because the trade cost was high relative to where I think the stock price would be. So hopefully that answers that question. That's why, because of the time component and implied volatility component, especially if you're purchasing a very far out of the money option, it's even worse there because time doesn't impact you as much because those are centered around at the money options, but it could affect implied volatility and all these other factors. So this even though it's moving, it's not moving as much because you've got low gamma and things like that. So lots going on with the options premium. And that all starts with understanding how an options premium works. And I really, truly believe once you understand an options premium and the Greeks, then you're golden. All right. Where are we at time? We're doing all right, 4:50. If you own a call, so a long call, unlike a short call, where if it's in the money, your stock is called away. If your long call is in the money, does the broker automatically buy the stock at the strike, or is it up to you to tell the broker what to do? I suspect most of the time you will just sell to close and take the profit, but curious if anything automatically happens by the broker like it does when you are short the call. Such a wonderful question. And that goes to how the assignment process or exercise process occurs. So first and foremost, this is prior to expiration. On the day of expiration, the OCC will automatically exercise any option that is in the money by 1 penny or more. That's the way that you automatically, unless they receive contrary instructions, that is the way that they ensure that you receive some value. Because if it's in the money by 1 penny, that option should be worth at least 1 penny, right? Before expiration, it has to be initiated by the long option holder. Some brokers, you could submit that online. It's very few. Most brokers, you'd have to call them. But normally you don't do that prior to expiration because you'd be giving up the time value component and then which means you're better off closing those options on the market. So selling to close those long options. But I think it's good to know this because a lot of times, especially now with this 1-day settlement, if there is a early assignment because something's deep in the money or there's the next dividend date on the short option side, this is why a long option holder has to submit the exercise instructions to their broker. The broker would submit those instructions, that notice, to the Options Clearing Corp, the OCC. The Options Clearing Corp will then randomly assign a broker. That could be the same one. This could be Fidelity, and then they randomly assign Fidelity, or could be Merrill, E-Trade, just for example, Robinhood, any of those. And then, so say it did end up going back to Fidelity, then Fidelity might have a first in, first out, or a random, whatever they have on file. Then that offsetting short option would be assigned. That's an overnight process. What you need to know is the long option holder has no idea if the short option holder has a covered call, a debit spread, an iron condor. No idea. They just know that they have a long option. And the subsequent broker could be the same firm or someone else. And this is an overnight process. And then the trade date is as of the exercise date, so the day before. And then I do have some examples of what would happen the day of expiration if you have a long option and what your firm will do. It varies broker by broker, but I've worked out a lot of them and seen the back end processes. So if you have an in the money option or something that is near the money or a high beta stock that's really close to it, a couple things to consider. One, there is something called a do not exercise. A do not exercise is where you say, hey, brokerage firm, normally got to call them up. This is on the day of expiration. This would be accepted only. Say you've got S&P 500 calls or whatever it may be. And you say, and you can't support the exercise, meaning you own the right to buy 100 shares of NVIDIA at $1,000 a share. That's going to require a lot of capital. And if you don't have that capital in your account, the firm is going to exercise their fiduciary responsibility and try to sell to close those options out on your behalf or submit a do not exercise. And sometimes you don't know. It honestly depends on volume. If a lot of people have those options, some firms have a click of a button where they just close everyone out. So there's a lot out of your control. That's why holding an option till expiration equates to risk. Important to know. If you submit a do not exercise, you say, hey, firm, I'm taking the risk. If I do not exercise these automatically, do not close them out for me, I will close them out. And if you don't close them out, then you don't gain any profit. But you take the risk off of the firm and you put it on you. I'd prefer that scenario. But again, holding options to expiration equates to risk. But this is what they would do for you in these different scenarios and what you can attempt to do. Usually you can just sell to close the option for the intrinsic value amount on the market. But if you cannot, these are other factors that you can do. If it's something that's out of the money, it's going to be a little more difficult to close because you need to make sure a market is there. You may not see a bid available, in which case you will be unable to close that option, but you could try. But nonetheless, this is what happens on the day of expiration. The reason why you're automatically assigned is because it's an automatic exercise subsequent assignment. Hopefully that makes sense. Okay. How do I close an iron condor trade? Do I let it expire or do I need to close it before the expiry date? So I don't have a screenshot for this one. I apologize, but if it is where it needs to be, an iron condor is just an extension of a short strangle. So if you have something in a trading range, you have your short call on the upper end, so you don't want it to go any higher than that. Your short put on the lower end. And so you need the stock to stay right in between those two prices. And then it's an iron condor because you have further out of the money options. So a long call and then a long put that mitigates risk if it goes too high, too low. So you need to stay in your trading range. That means this is a time trade. You need time to go buy. So it's going to depend on how you deploy this. When we are selling options, we normally look around the 45-day mark because that is ample theta decay. Theta is not, as in theta means daily time decay, daily extrinsic value decay. It's not equal. It doesn't decay the same every single day. For an at-the-money option, it's slowly, and then about 14 to 21 days to expiration, it starts falling off a cliff. As soon as you experience that falling off a cliff, which is around 14 to 21, that's when I would close it. Because if you've heard of, and if you're trading iron condors, expect you to, if not, let's learn it, is gamma theta trade-off. As theta decays, and so then gamma risk increases because that just means sharp directional moves. And that is risk for short options. This is a short option strategy. You don't want to increase your risk. So holding this past that 14-day period increases your risk because now your time value is going to deplete, but that means now the option is really sensitive to price movement. That's what high gamma means. It's the acceleration point. So now you've switched from its bicycle to a Maserati, and you don't want to be in a Maserati in a strategy that is neutral. So hopefully that helps. All right. Oh, I pulled the memo for this. I'm sitting on 230 shares of NVIDIA with a 10-to-1 split. What's the best way to play this before the split? One, congrats for owning that many shares. I hope you've done well. So one, explaining what the split will do. Two, options. It's important to understand. You can go to the OCC.com, look up information memos. You can just Google OCC information memos, pull NVIDIA. There was another one around the May area in 2021. Just make sure it's 2024. Here's the memo, the X date, everything you need to know. I wanted to understand what the adjusted options will do. They're just going to change the strike divisors. So everything divided by 10, which is an easy, smooth process. If it wasn't, then we would be having a different conversation. Let's talk about why a company would do a split. The reason why a company would do a split like this is purely for increased retail participation. A stock that is over $1,000 per share is very expensive for the everyday investor. Now, we have fractional trading now, so it's a little bit different from when these were more common, I would say, before fractional trading was introduced, aging myself because I've been around that long. But normally you would see an increase. Didn't happen with Tesla when I did split, but I think there were other factors that affected with Tesla. I think that's the case study that's coming up in the media quite often. But the intent of a split, not saying it's going to happen, but I believe in the NVIDIA story, is it is more retail participation, and the market is a function of supply and demand. If this is going to increase demand, then great. But know that a split equates to exactly the same. So you playing anything is you're already exposed to it. And I'm not sure the percentage of your portfolio that is. So it's important to think about that. It just equates to the same, meaning you have $100,000 of NVIDIA post-split. If the stock stayed exactly the same, you'd have $100,000 of NVIDIA. All it's going to do is increase the amount of shares, decrease the stock price. And one times the other is going to equal the same amount. It is a non-event for it, but it does incentivize, or at least it make it more accessible to retail. All right. Like Joseph's question, is it more likely the share price of NVIDIA will drop after the split? It varies, and I don't like pulling what happened on splits because the market mechanics are shifting. It used to not be 53% retail participation. We have 53% retail participation within the market, which means mechanics are a little bit differently. Post meme stocks really in this surge in retail participation, it's going to be interesting to see how retail reacts. So I'm not going to say which way it's going to do, but it is a loved stock, a highly traded stock, and it makes it more accessible. It's possible, but the market is forward looking and it anticipates these type of things. So if it's already anticipating that there will be high retail participation in addition to Blackwell chips and all those other things that they're talking about, that's probably already priced in. All right. Okay. Oh, there's my Apple chart. So I see these questions, and we can talk about NVIDIA. I have a lot of deep dives on NVIDIA. What are your favorite technical indicators, and under what market conditions do you use each indicator? So let's talk about the ones that I use. And here is my chart that I have of the S&P 500. This is my weekly chart. I combine it with the equal weight. So when I'm understanding the market, this is the one I start with, but I use other things to help understand. What I like to use really depends on market conditions. This is a 3-year view, so a larger view, and this is a weekly chart. I use the 13, 26, and 40 weekly moving averages first. You will hear me reference that all the time in the media, on the Fidelity in the Money. Anytime I'm talking about technical analysis, I will utilize one of those normally, unless something else is blaringly more important. The reason why 13 weeks is very close to the 50-day moving average, which is very commonly used, but it represents 1 quarter worth of prices. 26 is 2 quarters and 40 is 3 quarters. And the reason why I look at that is we look at the markets quarterly. We are constantly trying to determine the price of an underlying security or the overall market. And the report card season comes out or earnings comes out to tell us if we're really right or not. So the market's constantly consuming all of this data, headlines that there was an event with NVIDIA and there's all this Blackwell chip demand, and now we have these enterprise verticals. How is that translating? The question is always, how is that translating over to earnings? Is that something that's going to increase revenue? Is that something that's going to help on the bottom line and decrease expenses? What is that doing to profit margins? What is it doing to free cash flow? That's why the market reacts when there's layoffs. As unfortunate as that is an operating expense that's reduced with the way that accounting principles are. So, and the same goes with in the inflation picture. If there's any indication that they're going to cut rates, well, anybody who has a lot of debt is going to do really, really well because they don't have to finance it as much. And there might be all this CapEx spending on the side, and people might be more apt to spend on AI. So any indication of a cut will send a rally. So meaning the market's constantly consuming all of this data in search of prices, but those prices have their realization moments because it's prices go up based on earnings expansion, profit margin expansion. So I want to see from a technical perspective, how is, without looking at deep diving and all that, which I still do, how is it 1 quarter worth of prices? What's 2 quarter worth of prices? What's 3 quarters worth of prices? And look at the slope of the line, and then if the security is acting as support or resistance. So just those three are here, the 13, 26, and 40. You can see it acts as support at the top before the Fed started introducing their rate cuts. When they did, it acted as a means of resistance. Then I just look at the downtrend as a series of lower lows and lower highs. If we don't overcome those, then those become areas. That's where I tend to draw these lines here. There is a lot more, but I bring this down over time. And then once the line flattens, that's an indication of a trend turn. And then you can see how that just goes over time. So that's why I use the 13, 26, and 40. I look at the market quarterly. I want to see prices increase quarterly. And then that acts as really mean reversion. And is it to the upside or to the downside? And then I layer on the 200 weekly moving average. That is the secular trend, is what I like to call it. That was the market bottom back in October of 2022, right here. I watched that like a hawk. Very important to see there. And if we breached that, that could have been very, very bad. And that if this wasn't a screenshot in a live chart, we could pull out and you could see that support mechanism really as we go back in time. So that's an important factor to the way that I look at it. Then, so that's the way I look at what I call the trading cycle, and then the longer term secular trend. I add Bollinger Bands. Bollinger Bands represent 2 standard deviations. So meaning it gives me trend strength. Here, this was hugging the Bollinger Bands. The second it starts fading away, that means it's just the math of it. If you know how standard deviation works, is it staying at the higher end or the lower end? And if it's staying at the higher end, then I would assign trend strength. As soon as trend strength is fading, then that is just a flag. It's not something to follow constantly, but a flag. Does it find support? It did at 13, but it failed. That's bad. That's an indication. And then those widening means increased volatility. I'm talking too much about technical analysis. I probably could do this one for an hour, but these are my favorite indicators on a high level, the 13, 26, 40, and 200. I do use the Fibonacci extensions, MACD as well for crossovers. And then I layer on other items. This is the US dollar. I was looking at that in comparison because it's just the way that I can see dollar strength versus the overall inflation picture, and then correlations there, and then defining strong resistance and support. But the takeaway is, if it's something you want to implement, 13, 26, and 40 on a weekly time frame at a 3-year period, and I have steadfast rules. I am going to be a bull in this market as long as this 13 weekly moving average is sustained. And then if you watched my piece on Mad Money last week, I layered on a daily chart with a gap that I wanted sustained as well, which was the 52.50 at the bottom line. So there's a lot of layers that are there as well. And this is SMA, not EMA. EMA, MACD uses an EMA, so that's why I'm okay using EMA here, but EMA puts more weight on the more recent prices rather than equally distributed. So good call out. All right. Hopefully that answered that question. Oh, I did. Did I have the daily? No, I put NVIDIA in here because of the trend strength. And another example and zoomed in a little more. So when something has higher highs and it doesn't stop, you can do something called a Fibonacci extension. So you go from the beginning of the trend to the end, to the previous trend. Technically could have done it here too. So if this small little downtrend, and then I look for certain levels. So here, 130, 1323 is my next price target. Post split, that's just 132. So that's the way I would look for higher highs. And I like to utilize that I start using in addition to the Bollinger Bands I really get into. And then MACD, I would also add on RSI for confirmation. But if you guys want more on technical analysis, we can certainly do that because I'll go way deep into that. But someone has been asking about my NVIDIA view. I did pull some really deep dive into the options data yesterday. I was supposed to be on Squawk this morning and I was not, but I did do the research because options gives you path. And there was just crazy positioning on the OPEX cycle on June 21st. It was largely bullish, which that means the positioning is there, which means when options expiration occurs because of market maker activity, that actually could create downwards pressure, which means if there are sell-offs on options expiration, so Friday specifically, that could be buying opportunities because that's just unwinding of positions. Kind of like the inverse of the gamma squeeze, if that makes sense. All right. Now we're moving into the market mechanics side. So we've done with the options part. Let me check the time. 5:08. So I will keep going because there's not too much here, but I think I also really love the Ichimoku cloud. I did not have that in here, but thank you, Mark, for saying that. To have either a bullish or a bearish view, what time frames and indicators do you use? I think I just answered that. I start with the 3-year in the weekly. I am more of a long-term trader. I'll zoom into the daily to see if there's gaps and continuation patterns and look at those for confirmation, but I really rely more on the weekly. And then if I'm looking at overall market trend shift, for example, the October bottom in 2022, then I looked for that 200 weekly moving average, and then I'll look at MACD on a monthly view. I'll go even bigger. And if I see that and signs of divergence, that's a good sign. So I look for trend shifts often, but trading cycle is my tried and true 13, 26, and 40. IV Crush. I lied. We do have more options to talk about. Can you explain it? Yes. All right. So I have Tesla. I apologize. I pulled this from an earnings presentation and I didn't have the post event, but this helps explain it. Meaning this was the pre-event for what happened on Volatility Crush. Volatility Crush just means there's an inflated component of the options premium. So in this scenario, this was an at-the-money option, the at-the-money call, the at-the-money put. This is 1 day until expiration, so the day before earnings. It tells us, have you ever heard somebody say the implied move is about 9% or $20? This is why, because when we're options, whenever you're buying options, you're saying that you expect more of a move than the market anticipates. And sometimes it's a little more, the market is more correct around earnings because it gets this inflated implied volatility because we know that there is the binary event occurring. We know there's an earnings date and we know the stock's going to react based on analyst expectations. And then even more so what happens on the conference call. And that was very true with this. The day low, Tesla, the very following day was 202 and it was a 9% move. That's really close. That's what the volatility crush is. If I were to take this the very next day, they would not be worth $10 each, be around $1, if that, probably less. Well, the 2250 would have some value because it went down. But the crush part means it would only have its in the money value component. So this would have broken, it would have, the put would have done okay, but you would have broken even in the net strategy. Volatility crush means the inflated part of the premium goes away. And it's inflated around earnings. That's volatility crush. It means volatility is inflated. The event that caused the inflated volatility component, implied volatility component of the options premium has occurred, deflation. So that is the volatility crush. All right. Do you have a favorite strategy to take advantage of high IV after earnings announcements? That one really credit spreads. That's great there. After earnings announcements, if you're still bullish, a bull put spread, bearish, bear credit spread. If you find a range, put those together. Excuse me. You get an iron condor. Those are what I'd like to use when it is inflated. All right. The the forward guidance on the earnings calls kills everything. It does. The market really cares about that now, especially with AI. Which really leads into this. The market is at an all-time high. Is it because of growth or an abundance of enthusiasm? I really, really liked this question. And mind you, these are just my personal thoughts. But I interpreted this question as, is this growth or is this overhyped and is there bubble mentality? I've done a lot of deep dives into bubbles, and bubbles occur because like the dot-com bubble, for example, that was a lot of companies and a lot of IPOs. So remember, the market is a function of supply and demand, buyers versus sellers. Capitulation happens when sellers exit the market. And rallies or overenthusiasm is buyers with no clear path to profitability or no fundamental backing. So thinking about the dot-com bubble, like understand that for a moment. There were so many IPOs. Someone could be in their garage, put .com behind their company name, IPO on the market without any clear path to profitability. But think about when you IPO. When you IPO, usually the syndicate or people that are involved in the IPO have a 60-day lockout period. So their hands were tied where they couldn't offload those shares. Sellers who wanted to sell weren't there. So if there's a lot of IPOs, all of a sudden the lockout period comes in, then there was a lot of downwards pressure in sellers. So what I would look at to understand some type of correlation or if a similar aspect was occurring is a lot of IPOs, because what would cause downward pressure? Do the sellers have an opportunity to sell if there are negative? So that's one component of the dot-com bubble that is different from now. However, when crypto went through all of its volatility, very similar occurrence, because anyone could go ICO, and that had very similar bubble mentalities, maybe not necessarily with the lockout period, but meaning it was very easy to create, no clear path to profitability. Now, if we think about the AI narrative and the growth in the abundance, it is very alarming that one stock, NVIDIA, which makes up a huge component now of the S&P 500, is really driving the market. That is definitely risk. However, they have 75% profit margins, head and shoulders above the competition, and they're constantly innovating. And there's a clear path to profitability. They're receiving revenue. Their clients are, one of them made up 19% of the revenue last year. I think it was Microsoft. No one knows. That was the insight and analyst expectation. But when thinking about, is it an abundance of enthusiasm? Sure. And it's lots of buyers make stocks go up. And if there aren't enough buyers, then that can be a concern, right? And it's always forward looking. So when we get this indication of these new verticals, like it did with NVIDIA, or if Apple gives us something AI related, there's going to be more enthusiasm, creating more buyers. But is it growth? Well, does it translate to revenue, and what do earnings look like? And if that keeps occurring, then it is actually growth. So it's actually a combination. But if I've done so many deep dives on AI and the technology and revolutionary aspects, it all compounds on one another. We needed the World Wide Web in order to have what we have today. And soon we have the framework that's needed, or to an extent, not all framework, but to grow and compound on these technology agreements. And also, not everyone adopts it altogether. Some people are just now using ChatGPT for inquiries, whereas others are utilizing Perplexity and Zapier altogether to make all these automated integrations and things like that. And there's different products. Think about Microsoft still advocating for Clippy to come back, because I really think that's the best way we'll have ChatGPT, but who knows? Nonetheless, there is a lot of innovative happenings that's translating to real revenue, and it's being done by companies that have the cash, aren't over leveraged, And that's promising. Now, if all of a sudden we got all of these IPOs coming on where they have AI attached to their name and then they start making a huge component of the market, that could be bad. And then we'll start having this overabundance of enthusiasm and bubble mentality. But in all reality, we're also in a restrictive Fed environment. The second that starts coming down, there is CapEx on the sidelines that could come in, and then that would spark a rally. So there's lots of different narratives that have bullish market components sparking buying altogether. I'm not a bull or a bear just yet, but there's my thoughts, my stream of consciousness, if you will, of what's happening. Now, my headwinds, I do think is grid pressure, and I've talked about that a lot this week. Probably upload that to my Instagram later, but nonetheless, important to know. And there's increased competition. There's a good question or a good comment from Mark there about AMD takes until 2025 to get their AI out for sale. All of those, but remember, the market's forward looking. So if it anticipates this coming in, it's going to price that into the security until something else happens. My big concern is all of this AI that's promised does require a lot of electricity, and there's a lot, and we don't produce that much today. So there could be some headwinds up and coming, but if there's headwinds, there's opportunities for whoever makes that tailwinds. Nonetheless, I digress. All right. I think we talked about our potential lower support for SPY and QQQ on the previous S&P 500 chart. I'll bring it back up if you would like. Mine is, I will turn bearish if we have closes below all of this and it flattens out like it did here. That's a good indication of just a slight little bearish. But as soon as it flattens out in there, so that's indication one. My lower support is 48.18, which is the previous high before the Fed coming in, and it also aligns with because I drew it there, but the fib line. All right. And why don't you seem to like value sectors or stocks, and why? I kind of answered this one earlier, but I thought I would add a component to this. Those have been the people who are talking about it are anticipating a Fed rate cut. And I personally do not think that the value sector will increase until we have hard evidence that we will get a Fed rate cut, because they require financing and have debt. If they can do that at a lower rate, that's great. So if we have an indication, then I'd get more into value. But right now, from a technical perspective as well, growth looks better. That's why. So it's technical and also the overall inflationary picture. Interest rates, really. Okay. I gave a lot of thoughts on NVIDIA. This I know is the last question. Nope, we had the margin one. I'm going to stay away from the margin question. All right, so this was questions. I don't know if there's any other questions that you want to add. And we also have a session, or I'll be hosting a session for next week. I have not chosen that topic yet. So if there is a topic, this was probably the most broad-based session I have ever given. Thank you for the kind words. So I said to put that in the Q&A earlier. Let me check that, see if there's anything. But if you guys have anything that you want to cover next week, let me know. I do see that some people said I was a little fast. I apologize for that. I did this one a little quickly because I wanted to get in as many questions as I could. A lot of these were pulled from I probably pulled slides from 10 different presentations, which means if it's 10 different presentations, that's one concept that would normally be an hour. So yes, I had to go fast because of the broad base of it. But if there's something you want to deep dive into, everyone is saying technical analysis. Technicals. All right. That is resoundingly technical analysis. And we do recently have a leaps. Okay. Yeah, because we have a partnership with stockcharts.com, so we can use that. Why not do that? That sounds great. Okay. All right, technical analysis. We can do it. No worries. All right, that's what I'll do next week. So I'll put that together. Look out for that in your email. Thank you for attending today's session. I hope you enjoyed it, and I will talk to you next week.